Hey guys, so the Bank of England just released news that the base rate is now 3.5% in the UK. This coincides with the Fed in the US increasing theirs by 0.5%, and only a few hours ago, the ECB, the European Central Bank, also increasing their rate by 0.5%. Okay? So for today's video, what I want to do is break this down from a UK perspective. What does this mean for your personal finances, for your investments, for your mortgages, for first-time buyers, for your savings, for your debt? All of that stuff, I want to break it down step by step. So please be patient. I'm going to be looking at my computer to walk you through what this means for us at this time. Now, this has been released 10 days before Christmas. Yeah? And although, if you noticed in my last update, the Bank of England had increased the rate by a historic 0.75%, but this time round, the increase is a bit less rather, by 0.5%. So although on one hand you could say, well actually that's a bit of good news, that's signalling that inflation is reaching a peak, which people in the marketplace are viewing that from that perspective. However, that's not very good news for people. That's not very good news for everyday people, households in the UK who are at a point where they're trying to celebrate Christmas, for example, or prepare for Christmas, or just more generally in the winter season where people are really struggling financially, or even for younger people who have borrowed lots of money at a time when interest rates were a lot lower, but now facing historic rises in interest rates. So this is a really difficult time financially. So please bear with me as I walk through what this means for us financially. Okay. Now, I should mention that inflation numbers came out at 10.7%, which is still quite high, though a bit lower than what it was in our last update. Okay. And it's expected that inflation would start to then decrease. But bear in mind that the Bank of England's aim, their kind of long-term aim, is for inflation to be at around 2%. Okay, that's the goal for inflation. But as at the moment, it's still at around 10.7%. Okay. Now, at the meeting, the ECB, at the meeting, the Monetary Policy Committee, the MPC rather, voted, and the majority voted for this 0.5% increase. So there was a 6-3 majority vote for 0.5%. Compared to, in my November update, 7 people voted for 0.75% compared to 2 people who voted for 0.5%. So it's good to kind of see how those vary and how people are changing their vote only 1 month from when they made their last vote. Very interesting to see that. Now, from an interest rates expectations perspective, the Bank of England is expecting interest rates to peak at around 4.5% by next autumn, so 2023. But remember, this is the bank rate. And on top of the bank rate would then be margin that banks add in order for them to make some profits. Okay, so, but this is assuming that inflation is going to decrease, okay? And bear in mind, there is no guarantee that inflation will decrease materially. Although there's a lot of the noise right now is that it's peaked, okay? And we know what expectations mean. Forecasts, to be honest with you, never really turn out to be what's expected. So I'm saying that to kind of help you prepare yourself in the event that the expectations don't turn into become reality. What that will mean is that we would expect even more interest rate rises. So that's interest rates done. Let's talk mortgages. This is a big topic for everybody. If you are on a tracker mortgage right now, you will see an instant impact by the increase of 0.5% because your rate is directly linked to the Bank of England's base rate. Okay, so that's just a given. However, if you're on a standard variable rate, is a rate you go on to. Say if you finish your fixed rate deal, you just go onto that standard variable rate. You could see your repayments rise on the back of this if your lender decides to pass on that additional 0.5% onto you as a customer. Okay. Now I should mention that if you're on a standard variable, you have a choice. You can stay on the SVR or you can move on. And maybe get yourself a fixed rate deal. And I looked up some of the fixed rate deals before I started making this video. Current 2-year and 5-year deals. Some bit of good news is that they've fallen below 6%. That's pretty significant. Okay, so you can get actually a 2-year fixed just under 6% thereabouts, and a 5-year fixed at around 5.8%. Okay, and if you look closely, if you do a bit more research, use a mortgage broker and stuff like that, there are some more competitive rates that are nearer the 5% mark. So if you aren't currently on the standard variable rate, your consideration might be, do you know what? If the deal is good enough, if the rate's good enough, I might be tempted to go and fix at the moment. Although you might actually choose to stay put at the moment, but you never really know how long you'll be waiting for, because no one knows what the future holds exactly, apart from that we expect future interest rate rises. That's SVR. Now, if you are on a fixed rate deal right now, you will not be affected by the rate rises. However, the Bank of England made some announcements recently, and according to them, there are around 4 million people in the UK, households in the UK, that will face tougher mortgage payments come next year in 2023. 4 million. These are the people who are going to be coming out of their fixed rate deals, okay? Their estimate is that the typical mortgage payment will increase by a whopping £250 per month. That is huge. So they're going that the typical mortgage bill is around £750. They're expecting that to increase to about £1,000 a month, right? That's typical. So if you have much bigger debt, if your mortgage debt is more than the average, then you can expect a lot more to be happening from a mortgage perspective come next year. Now, I'm not here to just deliver bad news to you. So here are my suggestions for how you can start to prepare, because that's what we do on this channel. You've got to prepare for what you know is coming. It's about being practical. First, I know we're in this excitement phase of Christmas, but let's be real, okay? First, you need to start to budget strictly, okay? Don't overspend over this Christmas. Don't give people presents if you don't have the money. Keep your money to yourself, okay? Number two, if you do have money and you are in that place, and this isn't not everybody, some people will be, you can overpay on your mortgage. I'd highly suggest you do that, obviously making sure that you have put aside some cash flow for the events of emergencies, the events that, you know, like the worst case scenario happens. But if you still have some money, you can overpay, because that prepares you for the blow that will come when you move on to a really high, rate as soon as you come out of that fixed rate deal, okay? Next is for you to negotiate a pay rise. Now, I know this is controversial right now. It's completely up to you what you do with your time and with your career and so on. But if I was you, I'd be doing everything I can to negotiate a pay rise, okay? Next is to prepare for the worst case scenario. And I know this is crazy, but, you know, I don't like to, go on with the doom and gloom thing. But I want to be really real. Prepare for the worst case scenario. I'm not saying it's going to happen, but what if you lost your job? By that I mean, do you have enough of an emergency fund? Do you have enough of savings put aside in the event that that happens? Okay. Next tip is to stay on top of your job. Like really focus on working smarter. Okay. As we go into these tougher seasons where it's colder, people's finances are a bit more challenging. It affects people. It will even affect your employer. So stay on top of your work. Show up on time, go above and beyond, work smarter, work harder, all those things. Do them to stay on top and retain your job, okay? My next tip is to hustle your butt off. It's the start of the year. People are excited anyway. If you've been talking about starting a side hustle, anything that makes you making more money, go and please start it. Take it seriously, be smart, and you get a great outcome. And the money you make from that, put it aside and use it towards, boosting your cash flow, because cash flow will be ever more important in this season. We've made videos before to help you choose a side hustle, stuff like that. There's a really popular video we've got with various really practical ideas. I'll link to it below and above. Please go and check it out in your own time. Let's now speak to first-time buyers. Lots of you guys who watch our channel are first-time buyers, and this is a horrible time from a mortgage perspective for first-time buyers. So my suggestion is that in this time, if you are trying to buy a property, first of all, is it a good time to buy property? Is there ever a good time? To be honest with you, I'd say that the thing you really need now to really get yourself into a great place is to have a bigger deposit, because a bigger deposit will help you when it comes to stress tests and all those things, because right now, anyone who's trying to get a mortgage, buy a property of any kind, is facing tougher stress tests. So you need a bigger deposit, which obviously means not everybody has that big deposit, which means not everybody can buy right now. Now, however, saying that, and obviously tied to that is the more money you put down, the better terms you get. That's kind of why the deposit thing is important. But tied to that is, I wanted to mention about this whole idea of, is it now a good time to buy? The thing about that is, on one hand, there are opportunities right now. You know, not everybody's looking to buy property. Property prices are kind of, you know, wobbling a little bit, decreasing in parts, not decreasing in certain parts, and so on, okay? My point is there are opportunities out there. So on one hand, you could find yourself buying a property and getting a really good deal. However, on the other hand, it will cost you, the cost of borrowing is a lot higher. So you kind of have to weigh those things up. And if you're thinking long-term, as a first-time buyer, then if I was in your shoes, I would get in. I've said this before, and I'm not in no means using this as an excuse. When I was buying property, you know, in 2008, I bought at 5.99% interest rate. Yes, property prices were a lot cheaper then, relatively. I get it, because I know people say that in the comments. However, the point I'm making is I went in and I did it, you know, because I needed to. So if you need to at this time, then you need to go ahead and do what you need to go ahead and do. Next is to seek independent advice from an independent mortgage broker. Get some advice. Advice always helps you when it comes to getting the right mortgage deals. Now, let me speak to debt, because debt is a big deal. I had someone message me recently on Instagram. They'd borrowed a load of money to buy crypto, and they got scammed and lost all their money. A lot of people are in a lot of debt at the moment. So speaking to anyone with fixed rate deals at the moment, say for a personal car loan or just a general fixed loan, that sort of stuff, your terms will have already been agreed as far as your debt's concerned. So the current interest rate rises will not be hitting you per se, okay? It's where you are trying to borrow more money that you will see changes, because when the base rate changes, the base rate has a knock-on effect on every kind of debt, particularly things like credit card debt, because as we enter this season of Christmas, you know, New Year and stuff like that, people are going to be tapping up their credit cards and using money that they don't have to spend, essentially. So essentially what I'm saying here is speaking to credit cards, research shows that we are actually at a 16-year high when it comes to the cost of borrowing, and rates are reaching as high as around 30.3% from an APR perspective. So essentially what I'm saying there is with credit cards, if you can, please avoid credit cards. However, if you've already got credit card debt, then you might want to be considering, you know, like 0% transfer type credit card deals that don't have any interest applied to them, obviously. Yeah, so that might be stuff you might be considering from a debt perspective. If you've got bigger loans, say for example you've got large overdrafts, or you've got like multiple credit cards and stuff like that, you may want to consider consolidating your debt. But as ever, I would say you should seriously seek advice from debt counselors and stuff like that. We've got lots of content, by the way, to help you become debt free and stuff like that. Again, I'll link to that below and above. Go and binge on that playlist, and please apply the advice. Next is savings. Okay, so on top, you know, on the face of it, when the bank increases the bank rates, the base rate, that's great for savers on the face of it. Okay, what you see right now around this time with the rate rise is that we're likely to see easy access rates continue to rise. Yeah, so rates, based on my research, are around 2.85% for an easy access account, around 4.8% for fixed rate deals, fixed rate accounts, and then around 7% for a regular saver. So it would appear that rates look decent depending on the type of access and depending on the type of restrictions you are happy to accept. However, and someone did pick me up on this in the comments, they wanted me to elaborate on this, do note that although those rates sound great, we obviously have inflation. So the real return you're getting on your money is actually negative at this time, okay? So you might get excited and go, yay, sounds great, I'm getting a really good deal on savings. The real rate of return is actually negative, i.e., let's say, for example, that your interest rate is 3.5% and inflation is 10.7%, your real return is a negative of around 7.2%. It's actually a negative return at the moment, okay? But the good news is that as the Bank of England is expecting, they're expecting that inflation somewhat peaked, but they're not confirmed, but somewhat peaked. and they're expecting that interest rates will rise. What that will mean is that the gap that you have, that real return gap, will close, and that real return would improve over time. Okay. Now let's talk investments. Now, we've covered savings. Now, if you've been observing the stock market, not every single day, but just broadly, you notice that there's been some optimism in the markets, and the reason for that optimism is because the major central banks, Fed, ECB, and all the Bank of England, and so on, there's been a much less aggressive approach when it comes to interest rates, and that has caused for some optimism in the marketplace. However, I would say that over time, what we'd expect to see is that people will start to focus, would hope anyway, focus a bit less on interest rates and a bit more on the state of your local economy, for example, the state of the UK economy, and stuff like that over time. That might start to become the focus. Now, from an investment perspective, our approach, if you think about what's kind of happening right now, you might want to start to shift your money away from things such as, retail and travel and hospitality and what have you, or even the property market. Who knows? Depending on how you think about it, and move it more towards things that are much more guaranteed, like the utilities, your energy companies, and stuff like that. Or even moving your money more towards the dividend-paying companies, your dividend aristocrats, and stuff like that. Yeah. However, just zooming out more generally, we're still investing our money. We're still buying our ETFs. We're still buying our index funds. We're still buying those even now. Okay. But essentially, what I'm saying here is there should be a greater shift towards much larger companies that are much more international. So you might find more of those in the FTSE 100, for example. Or if you've got this long-term play from an investment perspective, which is what we expect anyway, you may want to continue investing, buying up tech companies because you're buying them a lot cheaper for a much longer-term perspective. But in any case, we're not selling anything at the moment. We're carrying on with investing. We're staying long-term and looking ahead into the future. Okay. Now that's all those segments covered. My overall thoughts. These are my overall thoughts. Okay. In summary, thank you for being patient, by the way, and listening to me. In summary, please don't get carried away over Christmas. Okay. I know we're going to get all excited. Everyone's going to be spending money they don't have. Don't be one of those people, because they will regret it after Christmas come January. That's the first thing. Don't get yourself in debt. Second, please budget and boost your savings, because 2023 is not going to be pretty economically. Okay. People are going to be struggling, and that's why we have this channel. We're trying to help you take action and be practical. Next tip, please hustle your butt off. Right. Can I even say that word on my channel? I don't know if I can say it, but basically work hard, okay? And work smartly. Being the start of the year, get in there and really do what you can to earn more, okay? And I've said this before, stay on top of your work. And finally, use this Christmas period as a time of review. Make it your admin period, review your investments, review your mortgages, have a conversation with your partner if you've got one. Basically, stay on top of that. Don't bury your head in the sand, get practical, and stay positive, okay? Overall, look after yourself and your family, okay? If you really enjoyed this video, I'd really appreciate it if you hit the subscribe button. We do our best to present you guys with quality information that keeps you on top of your finances and helps you move forward financially, okay? Thank you so much for watching today's video. And as we say, as always, in all things, be thankful and seek joy. Take care. Bye for now.